Hi, I'm Jim Jackson, and I'm bonding over bonds with Kevin Kazi. Kevin, we have seen pretty good performance to start the year in the bond market. Treasury yields have come off the highs that we've seen in 2022, but what are the other drivers?
So credit spreads have declined on hopes that China's reopening would spur global economic activity and the Fed would slow its pace of raising rates. We're also seeing some good economic numbers out there.
Sure, Kevin. I think that the primary one that we're seeing is that the CPI index, which measures broad inflation, saw its sixth straight month of a lower print. So inflation is coming down. So this decrease in CPI supports the narrative that the Fed might slow the pace of interest rate increases. The market is currently pricing in rate cuts by the end of 2023. However, the Fed is pushing back on this. As we saw on February 1st, the Fed increased its Fed funds rate by 25 bips. However, the Fed chairman did lean against the dovish ideas that rates might come down by the end of the year, saying that rate cuts were not appropriate this year on the current trends.
You know, it was definitely no surprise that they raised rates by 25 basis points, but it does appear that they will be slowing down on their rate hikes. They did insist that the need for further rate hikes to return inflation to 2%. Initially, most of the market sold off and then quickly proceeded to rally into the close at the end of the day. Also, trading activity increased dramatically across the street. It was definitely a risk-on trade after the increase. I will be interested to see how the market reacts over the coming year.
Sure, Kevin. That's obviously of great interest. What we're seeing is that recession risks remain elevated and that risk markets, such as credit spreads, do not fully reflect this heightened risk. However, we do take some comfort that historically when the Fed stops increasing rates, that the returns on broad fixed income markets are positive over the following year. So thank you, Kevin, and thank you for bonding with us over bonds.